most Americans alive today had not experienced the pain of high inflation, the time has come for policy to adjust. It is, of course, too soon to make definitive assessments. This period will be analyzed and debated long after we are all gone.
Why Jerome Powell, the Federal Reserve Chairman, is even speaking here? Well, this event is Jackson Hole Symposium and it was started back in 1978. It is sponsored by the Reserve Bank of Kansas City. Every time it is organized, it has a different theme related to the issues faced by US and world economies.
The worst of the pandemic-related economic distortions are fading.
But what's the importance of this discussion? Well, it provides clues of what is happening in the world economies and where things might go.
For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight.
In 2007, when the financial crisis took place, the theme was housing finance, and monetary policy. After pandemic in 2021, the theme was macroeconomic policy in uneven economy.
4.5 years after COVID-19's arrival,
the theme for this year is reassessing the effectiveness and transmission of monetary policy, and it will explore the implications and reactions of the monetary policy decisions taken by Federal Reserve in the aftermath of COVID-19 and why it led to increased inflation.
Today, I will begin by addressing the current economic situation and the path ahead for monetary policy.
Now let's understand what monetary policy is. So there are two types of policies. The first one is the fiscal policy and the second one is monetary policy. The fiscal policy is the one which is decided by the government of the country. Though monetary policy also has some indirect control of the government, but still it is the central bank which is responsible for the monetary policy. Fiscal policy mainly involves the tax rates, whether direct or indirect, whereas the monetary policy involves the bank rates and different sort of rates, basically has dual mandate.
Our objective has been to restore price stability while maintaining a strong labor market.
Price stability refers to the stability in money value. Whatever you can purchase today with $100, if you are able to purchase the same stuff within $100, even after 5 years from now, that will show the price stability. Now, it is the Federal Reserve which is responsible for this price stability.
And I expressed our unconditional commitment to fully restoring price stability and to keeping at it until the job is done.
Money supply in an economy plays a big part in controlling this price stability. There are various tools and operations used by the Federal Reserve in order to control the price stability.
We will do everything we can to support a strong labor market as we make further progress toward price stability.
Now take it as a game that Federal Reserve wants to control the money supply in an economy. There are various ways to do it. And if the inflation is high, which means that the money supply is high in the economy, now they want to reduce that money supply from the economy so the inflation can be controlled.
Inflation is now much closer to our objective, with prices having risen 2.5% over the past 12 months.
Now comes the concept of rate, and it is one of the tools to control money supply. Suppose if the loan rate is quite high, would you go for any loan? You will probably wait for the loan rate to go down and then take it. So when the loan rates are high, the money supply in the economy is reduced, as most of the supply is with the banks. And whenever the rate cuts are there, which simply means that the loan rates will be lower and people will be borrowing money from that and utilizing it for the purposes out there that can bring in more value to them as compared to the rate which they are paying on that particular loan.
The labor market is no longer overheated, and conditions are now less tight than those that prevailed before the pandemic.
Every economic activity is interconnected. Impact on one can impact the other economic activity as well. So the chain of this particular economic disruption started in COVID-19.
The limits of our knowledge, so clearly evident during the pandemic.
Due to Corona, unemployment increased to the new levels and people did not have money to spend as they were not working and not getting paid. So there was not much money in the hands of common people in order to spend it in the market and increase the economic activity.
It was a time of radical uncertainty and severe downside risks.
Now Federal Reserve had to step in and pump the money into the market. They printed a good amount of money.
While the task is not complete, we have made a good deal of progress toward that outcome.
This combination of increased unemployment and increased money supply in the economy led to inflation.
My colleagues and I judged at the outset that these pandemic-related factors would not be persistent. In short, that the inflation would be transitory.
And before Federal Reserve could take any further steps to control the inflation, Russia and Ukraine war broke out, which snowballed the effect of inflation.
Most Americans alive today had not experienced the pain of high inflation.
Now Federal Reserve had to take back all the money supply that they have pumped into the economy back into their systems. And for this, they had to increase the interest rates. Now people would not borrow. Now the businessmen won't borrow money for starting a new business. This way, the money supply could be reduced in the economy and inflation could be controlled. But this situation led to recession-like situation.
After a historically deep but brief recession,
now to control this recession-like situation and increased unemployment, they have to pump the money back into the economy. And that's why rate cuts are there.
the upside risks to inflation have diminished, and the downside risks to employment have increased.
And according to Federal Reserve, it is not the layoffs behind increased unemployment. Rather, it is the increased labor supply and reduced hiring. This phenomena actually happened in the aftermath of COVID-19, when there were not many jobs into the market and everyone wanted to hire people in order to restart their businesses. So an increased amount of labor supply was there, ready to be pumped into the labor market. This increased labor supply at that particular point of time. Due to this excess labor supply, companies had to stop hiring and also they did some layoffs. Now people are expecting the same rate of hiring which was there right after the corona. The unemployment rate was 14.8% after corona, which today stands at 4.3%.
Still low by historical standards, but almost a full percentage point above its level in early 2023.
Whereas the inflation rate was around 7% after corona, and today Federal Reserve says that it is going to be around 2%, which is their target, and since they have achieved their target, now they can work on unemployment and they can reduce it with their further policy decisions.
It seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon.
Uncertainty in rate cuts brings in the speculation in the market. The current range of the rate is around 5.25 to 5.5%, and market is betting that it will be around 3% to 3.25% by 2025. And it is only the time which is going to tell us the truth. According to experts, the possible rate cut might be around 0.25% to 0.5% in the upcoming meeting of Federal Reserve on 18th or 17th September. Now the question comes in, why this rate cut is important? Since we have already understood all the economic concepts, you would be able to understand it quite easily. Rate cuts will make loans cheaper, and when the borrowing cost is low, people will be borrowing more and it will infuse more money into the economy. And this money will flow into the different markets, whether capital market, money market, or different kinds of markets like real estate. And this is a positive sign for the markets. Fed might not reduce a significant amount of rate, but it will be cyclical and it will be reduced in different phases. So we should not expect a significant reduction in rate in the upcoming meeting of Fed. By the way, European Union has already reduced their rate by 0.25 basis points in June itself. So if all the markets around the world start reducing this particular rate, then money will be infused globally and this whole money will be flowing through different markets, and it will be an even bigger positive sign for the markets out there, whether capital, crypto, or others.
That is my assessment of events. Your mileage may differ.
But this is not a financial advice, as I'm not a financial expert, and you should do your own research before taking any financial decisions.
Thank you.
So I hope this video was helpful for you in understanding the rate cuts and Federal Reserve's different actions. And it was more towards the economic side rather than the crypto side, but economy side is also important and rather more important in order to understand the crypto side. Don't forget to hit that like button and also subscribe to our channel for more such helpful videos.